Okay, welcome again. And today I want to talk about leveraged ETFs. And now, if we're on the internet and we search for leveraged ETF, we find a lot of posts, a lot of news that say that, well, leveraged ETFs are not made for long term. Leveraged ETF are dangerous. Yeah, they have a decay in performance. There is explanation why leveraged ETFs don't match the performance of the market. Now, a lot comes down to the compounding issue that I want to address in a moment. But first off, so the ETF replicating the S&P 500 index is the SPY, the SPDR, and the 3 times leveraged ETF is the URPO. So if we look at these two over time, and this is since 2011, we see that the initial investment of $1,000 being invested in the SPDR grew to 3,700. Whereas if you were invested in the URPO, the 3x SPY, it grew to 14,780. Well, that's interesting because that's more than 3x the unleveraged ETF, because 3 times the unleveraged ETF, that's 11,000 and something. So, well, why is this talk that they don't match the performance? Now, number one is that there is a compounding issue. Because the leveraged ETF replicate the multiple of the daily return of an underlying index. So the idea is that here we have a sample returns over a course of 3 days. We have 5% plus, 5% plus, and 5% minus. And if we look at this, we see that compounded over the 3-time period, the simple performance is 4.7%. If you look at the double, the 2x leverage, daily leverage, it's 8.9%, and the 3x is 12.4%. And of course you see that that's less than what you would expect if you just multiply the 3 days compounded return times 2 or times 3. That's what you see in decay. So what do you have? You have a decay that is negative. Yeah. Similarly, you have this if you look at a positive 5% plus, minus 5%, minus 5% over 3 days. You have, of course, the performance is negative, but the performance of the leveraged, of the daily leverage 2 and 3x products are worse than you would expect just multiplying the compounded return with the leverage factor. So you have a negative decay. Contrary to that, if you have a streak of positive returns, so you have 5% on 3 consecutive days, interesting enough, the what we call decay now becomes positive. So you're winning from this. And similarly, also if you have a streak of negative returns, 3 times minus 5% on 3 consecutive days, again this decay term, this what many call a performance lag, is no longer a lag. It's actually a positive contribution to the 3-day performance. Now, the finding, how we can summarize this, is that the seesawing zig-zag result in a decay, effectively, yes. So volatility, like one day up 5% and next day minus 5%, is not is hurting the daily leveraged performance over time. However, streaks of positive or negative returns are actually desirable if you're holding a leveraged ETF. So let's look at the S&P 500 index. I'm loading the S&P 500 total return since 1990s from Yahoo Finance. I'm calculating the returns, and I'm calculating the the 2 and 3 times daily leveraged return of the index. If we have a look at the performance, you see that since 1990 to mid-February 2021, you had of the unleveraged performance of 19.8x. In the 2x leverage, you had your money multiplied by 152, and for 3x daily leveraged daily leverage product, you had your money multiplied by 387. So that's quite impressive. I believe we have a chart. So here you see it in a chart on a log scale, and your initial investment of 1 grows to 19.8 or close to 20 for the unleveraged, and 252 for the 2x leveraged, and 387. The impressive 287. Now, of course, this doesn't go without risk. You see massive decline in value where the stock market dropped in value. You see for the financial crisis, it was actually massive. You see for the Corona crash, and also the burst of the tech bubble. If we're looking at this over time, so we're looking at a 1 year, 252 trading days, rolling performance, or rolling decay, what we called decay before, we will see that actually what we have in black, so in black we see that the rolling decay of the 2x leveraged ETF. Positive means, of course, that it's contributing to the return. If it goes into negative territory below 0, it actually hurts. It's actual decay. What we also see is in red, I plot the 1 year rolling volatility of the unleveraged S&P 500, and you see, of course, during financial crisis, during stress period in markets, volatility skyrockets, while the decay generally goes into negative territory. And here we see the similar pattern with the 3x product again, that we see that when volatility goes up, the decay goes negative. Still, interesting enough, the green average is the line where we have the average of the decay, which is indeed positive. It's above 0. So to summarize this, is that we see negative decay indeed when volatility is high, when we have the seesawing action, the zig-zag patterns in price or in returns over from one day to the next. However, over the long term, we see a positive momentum possibly, and that causes the leveraged ETFs to outperform. The question, of course, does this actually work with leveraged ETFs? And we have what I showed you at the beginning, the SPY unleveraged. We have the SSO, which is the 2x, and the URPO, which is the 3x SPX. We load it again from Yahoo Finance, and this time since 2006, because that's when the SSO was introduced. We calculate the returns, and again we calculate the performance, and you see that the SPX since 2006, correct, 2006, returned 436%. You see that the theoretical Oh yeah, that is 436%. The SPY captured most of this upward performance. It got you 429. So of course this is connected to the performance fee, the management fee that is charged in the SPY, and also possibly a tracking error. Interesting enough, you would in the SPX times 2, you would have expected 1900% plus, while as the leverage ETF only got you 14.9%, and the actual daily 3x S&P 500 should have gotten you 50x. However, the URPO only got you 35. So of course this shows that there is some lag in the leveraged ETFs, but I would argue that it's not connected to the compounding, because compounding due to compounding you wouldn't expect to have it decay so much. Of course, we can also look at a less favorable period in 2008 to mid 2019. You see that the S&P 500 got you plus 13%. You had the 2x S&P 500 is plus 23, or the daily 2x. So this is less than the 2x, the simple S&P 500. So it doesn't mean, like, as we've seen before, when we have a volatile market, which indeed we had in 2018, we go more into the zigzag pattern that we have, alternating positive, negative returns over time, which hurt the performance, the compounded performance of leveraged ETFs. The key takeaways is that the compounding loss occurs in a high volatility markets with seesawing price action. That's what we've seen. Also that leveraged ETFs are not only for short-term traders, I would argue, at least in markets where you have a positive expected returns in stock markets in general. It might be another case in currencies, or if you're looking at commodities. I don't believe that if you just have a 2x crude oil or 3x crude oil leverage ETF, that you should expect this to happen, as we seen with the S&P 500. And third, leverage ETFs did a poor job in the past to explain the compounding loss. So still, like, we've seen that they lag generally behind the expected return by quite a bit. However, that's not due to the compounding, but more likely due to fees, due to tracking error, and also what I call a leverage premium. So people pay for owning a higher leverage product as compared to low leverage product. We see this with many other also high beta stocks. So that's it. In the next video, I want to show if we can exploit this performance lag in a trading strategy. So stay tuned. Thanks for watching, and goodbye.